Let's make money moves. So the first thing we're going to talk about is the different types of business structures. And number one, we've got a sole trader. Anybody can be a sole trader. You can be a sole trader tomorrow morning if you wake up and decide, I want a business. The good things about that is that the owner has total decision-making authority. He can do whatever he wants for the business. He's the boss. He's the head. Whenever he wants to do it, he can do it. It's easy to set up. It's cheap. However, there is one problem. It is not a separate legal person. And that means that if the business screws up and if he suddenly loses money and gets into debt, then they are taking his furniture because he and the business are seen as one legal person. So that means he has got unlimited liability. The technical term for it is unlimited liability. There is also no perpetual succession. Now, perpetual succession, we'll go over a bit later, but that means that the business can survive after the owner or owners has died. Obviously, because it's a separate legal person. This is not a separate legal person, therefore, no perpetual succession. Obviously, because the guy is on his own, or the girl, whatever, is on their own, they can't bring anybody else in. If they bring anybody else in, then it's something else. They have limited access to skills. Their skills are going to be the business's skills. They have limited access to capital because banks are not often willing to give sole traders massive loans because they are so risky. And they have got no tax write-offs. So the business will not pay tax. For example, if Jabulani is a painter, he has Jabulani's painting. He is a sole trader. Jabulani's painting will not pay tax. Jabulani will pay tax. So whereas companies will get favorable tax write-offs, sole traders don't get it. Again, everything goes back to the fact that they are not a legal person. Now, if Jabulani brings in Mandise, now it's a partnership. And it is two or more persons who operate a lawful business with the objective of making a profit. Now, what are the criteria for a partnership? So each person must contribute an appreciable asset. So something that is going to increase in value, be that money or property. And the business must be carried out for the joint benefit of all the partners. Now, the partnership is the first type of enterprise structure that's got a specific agreement running it. That is called the partnership agreement. You can have as many partners as you want. And the great thing is that unlike a sole trader, where the one oak skills are the skills that the business is going to have, the benefit of a partnership is you can have as many partners as you want, so you can have as many skills as you can get. But again, the problem with a partnership, not a separate legal personality, they're coming after everybody's furniture. Everybody is going down. The partners are jointly and severably liable. Meaning if there are 5 partners and they can fund all 5, then the debts of the business or the trouble that the business is in gets split 5 ways. If they can catch 1 out of the 5, then that one oak is responsible for everything. So the lesson in that is run away first. Obviously, they are not a separate legal personality, so the personal assets of all the partners are exposed. Partners enter jointly into any agreement that is done, anything at all. So all the partners are seen, whether or not they actually do so, but they are all seen as having consented. It's called acting in concert. It is believed, unless you can prove otherwise, and we'll get into that in a little bit, that they acted in concert, which means that they acted together. And obviously, any assets that are gained, any profits are divided equally amongst the partners. There's, again, as we said, no perpetual succession, but we'll get into that when we get into partners in greater detail in a little bit. So when one of the partners goes, finished, Mapa, thank you very much, done. and each partner is taxed in their personal capacity. It's not suddenly now a case of the partnership getting taxed. It is seen as a partnership is essentially a group of sole traders that are seen as working together. Now, let's get on to companies. We're doing this video is just an outline. And then as we've done before, then we will get into each one of the various different types of enterprise. So remember, company is registered in terms of the Companies Act of 2008. Whereas previously we had one sole trader, many partners. Now we call the owners shareholders, and they contribute money. 9 times out of 10, they contribute cold, hard cash. Sometimes you can get assets, maybe once or twice, but that is the exception rather than the rule. Usually you buy parts of the business, which are called shares, for cash, for money. There used to be a limit on the number of shareholders you could have. You used to be only allowed to have 50. Now you can have as many as you want. And the fact that you now can have as many as you want means that the business is able to raise a lot of money through the issuing and offering of more and more shares. Obviously, the downside is that this dilutes the shareholding of the current people. So there needs to be a fine balance there between what has been issued and what is going to be issued. Now, very important thing to remember is that the sole trader is the boss man. He's the owner and the boss man. Partnership, unless the partnership agreement says differently, the partners are the owners and the boss people. In a company, it's a little bit different. Companies Act of 2008 says the shareholders do not necessarily run the company. That is done by directors who are appointed by the shareholders. So in maybe a sense, they do. And there is a large amount of legal regulation, not just the Companies Act, but the Income Tax Act, the VAT Acts. There's dozens of acts that regulate companies. And they're very costly to manage. Why? Because this is the first type of enterprise structure that is its own legal person. It has perpetual succession. So if you have 5 original owners and those 5 die, the company can still survive as long as it was passed on to new owners. It can survive in the original incarnation. In a partnership, as we've said, it can't. A new partnership has to be created. So remember, sole trader, you don't need any documents. Partnership, you need a partnership agreement. The company, you need a memorandum of incorporation. Remember what we said previously when we did this? A company, legal person, gets its own separate rights and personalities. We'll get there in a little bit. And because of this, the shareholders have got limited liability, meaning that they will not come for your furniture to a greater extent than they have to. If they do, that will be because of corporate fail. But again, we'll get there later. I know I'm saying this a lot, but this is just this video is the introductory unit. This is learning unit 1. So partner, they will take you for everything. Sole trader, they will take you only for what they can I'm messing up here. A partnership and a sole trader, they will take you for everything. Company, they will only take you for that which you have gained or that which you have invested, and only under corporate veil. We'll get there later, but just know that they have limited liability. Now, something that is no longer done, you can no longer register them, is a closed corporation. Those came in under the Closed Corporations Act 1983. Companies Act said, we don't need them anymore because it's now much easier to register a company. Registering a company is now a legal right, as opposed to it used to be a privilege. Now it's a legal right. It's much easier to register a company. It's not so bloody complicated. We don't really need CCs anymore. CCs were seen as a much easier way to register a company or a company type structure. Also separate legal personality. They came in 1983, and the thing was that you had 10 members. Remember, they had to be natural persons. So you could not have a juristic person like a company as part of it. Now CCs were created by a CK1 form. But you could also have an association agreement, which was like a partnership agreement, which would regulate the association between the different members of the CC. And think of a CC as a bit of a mix. It's got a couple of partnership characteristics. It's got a couple of company characteristics. Again, the members have got limited liability. However, I'll repeat myself again. We'll get into this later. They can have certain circumstances where personal liability becomes a thing. That is mainly to do with corporate veil. What else have we got to say here? Yes, so 10 members must be natural persons. Now, the last one, little bit weird, is a business trust. Now, I remember that there was some confusion and the notes were not very clear last time, and everybody was like, ish, now what? As to, is a business trust like a special thing? Business trust is it is an arrangement whereby a trust is allowed to do business like a company. And it is basically an ordinary trust. It's an ordinary trust, but it is run like a business. The trustees are given wide powers to run the place like a business in terms of the trust deed. So what that means is usually trustees are not allowed to put the assets of the trust in any type of gambling situation. I call it gambling situation. They're not allowed to play with the trust assets. Like they can't speculate with the trust assets. But under a business trust, the trust deed specifically says that they can. It is not a juristic person. It is a contract. If it is an inter vivos trust, remember, inter vivos trusts are created during the person's lifetime. A testamentary trust is a legal thing. It comes into formation upon the death of the founder of the trust. But an inter vivos trust is just a contract between various stakeholders. A business trust can have perpetual succession, but usually trusts are seen as having an infinite lifespan where they will never die. The only time that they will cease to exist is if they are wound up. There's no limit on the number of trustees. There's no limit on the number of beneficiaries. When we do business trusts in more detail, we will go through the fact that there are certain exceptions to that rule. Trustees, the beneficiaries are like shareholders. The trustees are like directors, and like any director worth their salt, a trustee can get personally funged for negligence and mess ups during their time in office. But to sum it up, really, the word trust is used to describe a relationship between people and assets. Right, let's talk about the type of companies that we get. First we get is a public company, and that ends in LTD. It is for profit. It is listed on a stock exchange. South African companies are listed on the JSE. You cannot control who buys shares. That's not a thing. If the shares are available, anybody can buy them. The directors don't get a say. Different to a private company, which ends in Pty Ltd. It is also for profit, but the MRI, remember MRI's Memorandum of Incorporation, that prohibits the offering of shares to the public. So if Johnny wants to sell his shares to me and we come up with an arrangement, that is by and large fine. Obviously, there will be criteria and restrictions on that, but if we do it and we follow all the rules, by and large, that's fine. If I go and hold up my trust share certificate in the middle of the street and say, who wants it? You can't do that like you can in a public company. So what makes a company a private company is the MOI prohibits offering of shares to the public, and it restricts the transferability of shares that exist. So usually you have to get the consent of the board. By and large, it's a given that they will give the consent, but the fact that they could not give the consent or they could refuse it is what makes it a private company. Then we get state-owned companies, also called state-owned enterprises. They end in SOC, in brackets, LTDs, state-owned company limited. They are also for profit. They are either owned by a municipality, which is by and large the case, or they are listed in the Public Finance Management Act. Remember, very important to know legislation. Public Finance Management Act. So they're either owned by a municipality or they are listed in the Public Finance Management Act. They are a juristic person, the same as public companies, same as private companies. The only difference is they get their cash from the National Revenue Fund or from tax money, and they are controlled by the national executive. So they are controlled by government. And they are supposed to, in theory, run like a business. They don't, but they should run like a business. And they are run in accordance with ordinary business principles. So the accounting standards, same sort of management structures, chairperson, board of directors, managers, etc., as a normal company, except that they're usually bailed out by the government. Now, accountants, lawyers, docs, these sorts of people use this. Personal liability company ends in Inc. That's when you want a partnership, but you must want some of the benefits of legal personality. It's usually, as I said, used by lawyers, doctors, entrepreneurs, stuff like that. And it's usually to ensure that there is perpetual succession, particularly if you've got partners going in and out all the time and you want to have some sort of reputation that is kept intact over a long period of time. So, however, the Emma, I will say that if you want to change, there are certain criteria that you have to fulfill. You have to tell your regulatory body, you've got to tell any interested stakeholders, and you've got to do that in a particular amount of time. Now, a non-profit company, MPC, can be anything as long as it is done to the public benefit or it is done to the benefit of a particular cultural or social group. So just as like the SPCA or the Haven Night Shelter is a non-profit company, so could a company that advances the culture of the Zulu. They could both be, because they both fall into that criteria. All the assets, all the income needs to be used for the benefit of that particular group. Nobody can take a profit from it at all. There's no dividends, there's no nothing. It is all put back into the business. Obviously, people get paid a salary or a wage, but there's no profit. Okay, now let's talk about external and domesticated companies. So an external company is a foreign company that intends or is conducting business in South Africa. They are registered overseas, but they conduct business in South Africa over a long period of time, usually 6 months or more. So like Toyota is an external company because they're registered overseas, but they do business here permanently. You have to register with the Companies and Intellectual Property Commission within 20 days after it begins activities in South Africa. If you don't, they're going to fine you, they're going to kick you out. Yeah, so to recap, foreign company that does business in the long term in South Africa. It doesn't matter if you have a bank account or you've done business once for like a day, or you've had a meeting, or you own property in South Africa. That does not necessarily make you an external company. There are very specific criteria that makes you an external company. You've got to be here for 6 months or more. You've got to tell the commission within 20 days of you arriving, 20 business days, so about 4 weeks, that you are going to be here for that. If you don't, hulle skop jy uit. A domesticated company is a foreign company who has transferred its registration to South Africa. So external company, the registration is still overseas. Domesticated company, they are here now. And it is done in terms of Section 13.5 to Section 13.9 of the Companies Act. Now, there are certain criteria which we will discuss. So you have to have most of your assets in this country. Most of your employees and directors need to be South African citizens. The transfer has to have been legal from where you're coming from. So if you're coming from St. Kitts and Nevis to South Africa, you must have been allowed in St. Kitts and Nevis to transfer your assets to South Africa. If you are insolvent or you are sketchy with your money and you don't pass the solvency and liquidity test, TSAC, we don't want you. So those are the main criteria, and obviously most of your shareholders need to be South African. So also another very important thing, we didn't go over this last time, but I think we should. So what are the 10 elements? Now, if they're going to ask you a list on this particular section, they're going to ask you this. What are the certain things that you need to discuss with a client on, they've come to you with a business, what business structure are we going to create for them? So the first thing is, are you running a business where particular laws apply that necessitate that you form a particular business structure? So the first thing is applicable law. What law applies to your business? Does that law say that you have to register as a certain thing? Second thing is different types. Tell the client what different types of businesses there are, what type of business structures there are, and how that can best fit in with their structure so that they follow the applicable law. So what law applies to the client and their business? What structure matches that law? Then, do we need it to be a separate entity? Does it need to have its own legal personality? If it's a company that's doing 500 million rand a year in sales, then it probably does need to have a separate legal personality. If it's doing like 5,000 rand a month, then it can probably be a sole trader. So the three things so far are applicable law to that particular business. What type of enterprise structure is going to match that law? Does it need to be a separate legal entity? Fourth thing is control. Does the client who's starting the business, does he want to keep control entirely? If he does, then maybe a sole tradership or a partnership. If there is okay with a delegation of control to someone else, such as a director or a manager, then we could do something like a company. So the four things, I keep doing it down the list so that we remember as the list gets bigger and bigger and bigger each thing. 4 things so far. Applicable law, different types. So the applicable law, different types, legal personality, control. Next thing is perpetual succession. Does there need to be perpetual succession? I'll use the same example as I did previously. If the company is doing 500 million a year in sales, yes, probably there does need to be perpetual succession because that's too big to F up. But 5,000 Rand a month company, you can leave as a sole trader. Next thing number 6, number of members, number of people involved. If it's one client that comes to you on their own behalf, then obviously, and they're not a massive business, then obviously it's probably going to be a sole trader. If a couple of people come to you and they want something very simple, not a lot of regulation, probably going to be a partnership. If they want perpetual succession, it's going to be a personal liability company. And obviously prior to 2008, you could have said CC if it was 10 members or less. So there, not so much anymore, but for certain things, there is a restriction on the number of members you can have. Number 7, personal liability. Do they want their furniture carried out? Are they prepared to have that happen? If they are, then they can go for a partnership, personal liability, sole tradership. If they're not, they bloody well better go for a company of some kind or a business trust or something with separate legal personality. Tied to this is thing number 8. What rights and duties do they want to have? For a sole trader partnership, you have absolute rights. So you have the ownership and rights over all the assets, any profits, whatever. You also have unlimited duties. So it's on your back if it succeeds or fails completely. You're jointly and severally liable. Same thing in a partnership. They will fung you and fuck you up if it's a mess up. So if they're prepared, if they want all the rights and all the duties, then something without separate legal personality. If they want to give some of that up, then something with separate legal personality. Number 9, financial statements. Obviously all businesses to a certain extent need financial statements, but are they making enough money to necessitate the accounting, auditors, financial statements, stuff like that? If they are, then they probably need to be a company. If they're not, and we can be a little bit more lax, then partnership, sole trader, stuff like that. And the last thing is business name. Do you need to register? Obviously, you've got no protection as a sole trader. If you call your little sole tradership Jabulani's Plumbing, and somebody else registers a company Jabulani's Plumbing, they register it. It's protected for them. So if you want the name protected, you better register as a company. So let's quickly whiz through the 10 again. Does the business have law that applies to it? Does the law say that the business has to be a certain thing? What are the types of business enterprises on offer? What will best match with the law that applies to that business? Do the owners want it to be a separate legal personality? Does it need to be a separate legal personality under law, or because of the circumstances? What level of control do they want? Do they want absolute control, or can they give a little bit up? Perpetual succession, number of members, personal liability, who's going to have it? Rights and duties, again, who's going to have it? Do they want everything, or are they going to give some of it up? Financial statements, do they make enough money that they need to have an auditor? And then the business name, do they want to protect the business name? If they do, then they must register it. Right, last thing in 1 minute, stokvels. Stokvels, it's an informal savings group in African communities. It is essentially, it exists because of social contract. It is a pooling of money together. So every single member puts in a certain amount of money or assets, and then each month, each particular member gets the sum total of that. So if there's 12 members a month and each puts in 12,000 Rand a month, each month one person is going to walk away with 12,000 Rand. And it is used for investments, parties, funerals, stuff like that. But it exists because of social contract. And because a lot of the African communities historically did not have access to banks.